Dollar doesn't have to go to zero. You know, even if it went down by 80% and it retained 20% of its value, that's a major loss for, you know, Americans. And, you know, that would imply a gold price increase of 5x if the dollar were to lose 80% of its value, just for the gold price to stay the same in terms of other currencies. And so, you know, 5x from here is over $20,000.
The precious metals market is entering a powerful acceleration phase as the dollar weakens, inflation pressures rise, and investor confidence shifts away from speculative assets. With currency purchasing power eroding and global demand strengthening, gold and silver are now responding to structural forces that have been building quietly for years. An 80% decline in the dollar's real value alone would imply a five-fold move in gold to maintain parity with other currencies, placing long-term equilibrium above $20,000. Silver is positioned even more aggressively, sitting just beneath a breakout that could push it toward new all-time highs before year-end. As physical demand expands, constrained mining output and limited new supply create the conditions for price to become the primary market clearing mechanism. Peter Schiff, chief global strategist, emphasizes how these dynamics are setting up a continuation of this year's powerful trend, with gold targeting the $5,000 to $7,000 region in the years ahead, and silver retaining the potential to reach $60 to $100 as investor rotation accelerates. The expansion of central bank buying, weakening economic conditions, and rising pressure on the Federal Reserve all highlight why metals are outperforming speculative markets, and why private investment is now preparing for the next leg higher. Now we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
A lot of money that might have gone into crypto will go into gold instead. And I think the central banks that had been buying gold are going to continue to buy it. They'll probably buy more. And I think other central banks that hadn't gotten in, I think they're going to follow the lead of those who did. So I think that you're going to get even more central bank buying in the years ahead, but you're going to get the addition of private investment, which really, you know, wasn't happening to a large degree, you know, in the U.S. or maybe in Western Europe. But I think that's coming. I mean, I wouldn't be surprised to see $60 silver before the end of the year. In fact, I think silver is going to make a new record high before gold, because gold is around 41.30 or so, 31.40. It needs another $300 or so to get a new record high from that spike, whereas silver is only about $1.50 away from a new record high. So I think we're going to see a new high in silver. And the mining stocks, you know, so far this week, we're 3 days into the week, and I think the GDX and GDXJ are up like 10% already on the week. We have a 5% up day today. I think we're up 5% on Monday. We were kind of flat yesterday. But that's a pretty big move when you see 10% in these mining stocks, you know, over the course of 2 trading days. If gold doubles from here, we're not that far from 10,000. We're like, you know, 8,300. So I don't know how much different the world would look. How much different does it look now versus when gold was 2,000, right? Looks pretty similar. So I don't think it has to be a major, disruption in the world for gold to go to 10,000. But I think that if gold does go to 2,000, it will likely be in an environment where the U.S. dollar is weaker than it has been. And so I think you're going to have a more inflation in the U.S. We'll probably be in recession, and the Fed will probably be cutting rates, or they may already have them at zero, and they'll be doing quantitative easing. And there's a good chance that those are the factors that drive gold to 10,000. It may not be that gold goes to 10,000 and then we get QE and lower rates. It may be that we get those things first, and that's the impetus to get us to 10,000 and then beyond, because I don't see that 10,000 is some, line in that gold can't cross. I think that we're headed higher than that. The only question is, how long does it take to get there, right? I mean, how many more years will it be? But, it's going to get there. But I think it will get there sooner than a lot of people think. But as the price of gold goes up and up and up, gold that was uneconomical to mine becomes profitable. But even once you make the decision that you're going to begin mining operations because the price is high enough to justify it, it could be many, many years before you're actually in production, you know. So I think any significant increase in supply to meet a surge in demand is not going to come. I think it's more likely that you're going to get increased supply from retail where they just, you know, melt down their jewelry and stuff and to meet investor demand, right? Especially if you get a situation where people are struggling, the cost of living is going up, there's high inflation, they can't make ends meet, but they've got some, you know, bracelets and some, you know, necklaces that now are worth $10,000 or whatever, and now they'll just sell it because they need the money. So that could be one source of supply, is that, and that'll happen with silver too. Like people will start, you know, melting down their silverware. I mean, they won't melt it down themselves. They'll just sell their silverware to, you know, a company that will take it and melt it down. But you know, to build a new silver mine and you know, find the silver, you know, build the mine, get it into production, get all the permits. I mean, it takes a long time. And so, yeah, I think it's going to be price that's going to clear the market. It's not that there's going to be a lot of supply to clear the market. There's just going to be a much higher price. And as you have a higher price, you know, you don't need as much supply. So if somebody wants to put $1 million into gold, if the price doubles, then they don't need to buy as much gold to fill the order for $1 million. So I think that's really going to be the market clearing mechanism that balances supply and demand. It's going to be a much higher price. And I think that a lot of the gold that has been bought, not counting central banks, and of course the central banks are not in the United States, they're foreign central banks. So that in and of itself is a transfer. But I think the private investor demand has come from outside the United States. I don't think there's been a lot of Americans. There's some. I mean, we have American customers at Schiff Gold, and you know, other gold companies have U.S. customers. But I haven't seen a real pickup in business at all over the last couple of years. So I don't see more Americans getting into the gold market. The Americans that were already there, they continue to be there and buying more gold. But I think a lot of Americans have unfortunately gotten involved in Bitcoin and other crypto instead of gold. And, you know, that's going to be a big problem because those markets are going to implode. And so the people are going to have nothing when they could have had gold. And instead they've got, you know, worthless tokens. The dollar doesn't have to go to zero. You know, even if it went down by 80% and it retained 20% of its value, that's a major loss for, you know, Americans. And, you know, that would imply a gold price increase of 5x if the dollar were to lose 80% of its value, just for the gold price to stay the same in terms of other currencies. And so, you know, 5x from here is over $20,000. I'm very bullish. I think it's going to be a follow-on year to this year. I don't know that it will be a double, you know, like it was this year. It could, or it's not. Gold and silver hasn't quite doubled on the year, but I would not be surprised at all to see $5,000 gold. We may even get there this year, but I think 7,000 gold is certainly in the cards for 2026. You know, it could even be higher. It depends. We'll see how the midterm elections go, which is later in the year. If we're in recession, you know, what has the Fed done with monetary policy, especially under, you know, a Trump-controlled Federal Reserve? There's a lot of stuff that can go wrong that would go right for gold and send the price a lot higher. So it's hard to guess, but I'm going to say it's going to be substantially higher than it is now, and so will silver. And I think silver will continue to outperform gold. I would not be surprised to see $100 silver next year.
Persistent inflation, deepening affordability pressures, and unresolved concerns surrounding U.S. gold reserves are fueling broader doubts about monetary stability. The abrupt silence around auditing Fort Knox reflects how sensitive the issue has become, especially as any revelation of missing bullion would send gold soaring and the dollar sharply lower. Rising living costs, expanding deficits, and stimulus-driven spending continue to erode purchasing power, while political promises of relief only accelerate the underlying problem. With policymakers relying heavily on rate cuts and renewed liquidity injections, the environment remains highly supportive of precious metals and deeply challenging for overvalued tech and speculative assets. Crypto's fragility, built more on narrative than intrinsic value, adds another layer of vulnerability as weakening demand collides with structural inflation. These pressures reinforce a shift toward tangible assets as investors prepare for policy missteps, recession risks, and continued monetary expansion. Now, let's get back to the interview.
Well, what about Fort Knox? What about the gold? We haven't audited that. Let's make sure it's there. So, Trump knows that there is a group of people that supported him that would very much like to audit the Fed, and so he's kind of appeasing them by saying, yeah, let's go in there and audit the Fed and let's go look at Fort Knox. But my guess as to why they just kind of dropped that whole discussion without saying anything about it. I have a feeling that somebody told the president that it wouldn't be a good idea to audit Fort Knox because the gold is not there. And maybe they have to get it back. Maybe it's been loaned out or who knows what. But I think that's why they just stopped talking about it abruptly, because they realize that that's not going to be good for the U.S. if we end up going to Fort Knox and it's just a bunch of cobwebs, right? Because the price of gold would skyrocket if we didn't have what we claim we have, and the dollar would drop, and that would be a big problem. So Trump may think, even if the gold is there, if there's a chance it's not, why take that chance, right? It'll blow over, right? Let's just ignore it, and people will stop demanding an audit. But I think inflation is persistent. It's not going away. It's going to get worse. That's why, all you hear in the U.S. media is there's an affordability crisis. Everybody's talking about how expensive everything is. Yeah, that's a consequence of inflation. And, even the politicians are all trying to find a way to deal with affordability. That's how, Mandami, this commie got elected mayor of New York. It was all about things are too expensive. You can't afford food. So the government's going to open up grocery stores. You can't afford rent. So we're going to control the rent. You can't afford to get on the bus or to ride the subway. So we're going to make that free, right? It was all about how the government's going to help bring down your cost of living. But the reason the cost of living is so high is because of government. This is a consequence of government policy. In particular, the massive budget deficits that we're running every year, all of that government has to be paid for. And if we're not going to pay for it through legitimate taxation, then we pay for it by inflation. They expand the money supply, and then they give out that money to people who then go and spend it and bid up prices. So when you the cost of living is really a cost of government crisis. It's government that's getting expensive, and we're paying for all that government through inflation. So that means instead of paying taxes, we just pay higher prices. But it's for the same reason. First of all, those stimulus checks are not the solution, right? That's throwing gasoline on the fire. When you have an inflation problem, because you have all this excess demand that's been created by the cheap money, throwing more cheap money at the problem just stimulates the problem. What we need are massive cuts in government spending so we can reduce that demand and we can reduce the pressure on the Fed to monetize debt by creating more inflation. So none of that stuff is going to work. It's all going to contribute to worsening the very problem that they claim they're trying to solve. The main difference with the crypto bubble is that there's no substance there at all. It's all hype. It's all based on a story. There was something of substance behind the dot-com bubble. And the same thing with AI. There is something real there. But with Bitcoin and other crypto, it's generally all just, a fairy tale. But it's one that, people who are very smart are telling that fairy tale, and then other people are believing it, or they have a financial incentive to believe it, so they believe it. But now that the Fed is reassuring the markets that the rate cuts are coming in December, the market's got a bit of a bump. But look, I still think they're not out of the woods. I think that tech valuations are very, very stretched, and there could be a substantial correction at any moment. It's hard to say with the Fed wild card what they might do. But I think there's much better investment opportunities abroad than betting on more Fed stimulus here at home. They're already prepping for that, right? They're already talking about rate cuts, that they're a little bit more worried about the job situation than they are about inflation. So look, the Fed wants to cut rates. That's really the only tool in its chest. And so, it's gonna use it. It's not going to work, but that's not going to stop them from using it.
The economic pressures building beneath the U.S. financial system are becoming increasingly visible as structural inflation, political incentives, and long-ignored monetary vulnerabilities converge. Rising affordability problems, reflected in higher food, transportation, rent, and daily living costs, are not temporary distortions, but symptoms of a long cycle of fiscal excess and monetary expansion. The escalating budget deficit continues feeding this dynamic, with the growing reliance on money creation pushing prices higher regardless of political promises or proposed relief programs. This environment has drawn renewed attention to America's gold reserves and the abandoned push to audit Fort Knox, a debate that faded unusually quickly after early enthusiasm. The abrupt silence signaled something larger, especially as any hint of missing bullion would trigger a rapid repricing of gold and a meaningful deterioration in confidence toward the dollar. At the same time, crypto markets are revealing their structural fragility, lacking the underlying utility or monetary foundation that historically anchors long-term value. As speculative digital assets unwind, the contrast with tangible monetary metals grows sharper. Meanwhile, the Federal Reserve appears prepared to pivot back toward rate cuts and expanded liquidity, not because inflation is defeated, but because economic momentum is weakening. Rising recession risk, stressed consumers, and political pressures ahead of the upcoming elections make further easing almost unavoidable. These conditions favor assets tied to real value and finite supply, with long-term projections pointing towards $60 silver near-term, $100 silver within the broader cycle, and gold advancing toward $5,000 to $10,000 as the dollar weakens. Capital is steadily rotating toward traditional monetary anchors. The transition is unfolding quietly but decisively. As more investors recognize the limits of stimulus, the fragility of speculative bubbles, and the persistence of monetary inflation, precious metals continue to reinforce their role as the final source of stability in an uncertain era. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.